Right, good people, please welcome to our session, introduction to group financial statements. Right, introduction to group financial statements. You will forgive me, my network may not be very stable. We don't have power, so the network is a bit bad. I'm using a battery. Right, introduction to group financial statements. Right, that's the title of our, or that's the description of the module, FAC 2602. This network. Right, so introduction to group financial statements. Right, so far we have looked at FAC. I'm hoping that we've done FAC 2601. There is a possibility we are doing this concurrently. Right, but so far in our previous module, 1501, 1601, and 2601, right, we have looked at a company that is a single standalone entity without a relationship with other entities. Right, however, we do have situations where an entity invests in the shares of another entity. Right, where an entity invests, right, in the shares of another entity. Right, we are saying a group may be formed. This network. Right, a group of companies may be formed. Right, so this is 1, 2, 3, or 4 or more companies that have got a relationship. So a group of companies can be formed. So if an entity invests in the shares of another, a group of companies may be formed. Right, and then in this module, right, right, we account for, right, a group with a parent and a subsidiary. Right, so it is quite possible to have a larger group, right, where a company maybe make various investments in other companies such that the group can contain more than 2 companies. Right, however, that type of group will deal with it later when we get to later stages. Right, but since this is an introductory module, so things are kept a little bit easy. So you only deal with a company or with a group that comprises one company, one parent and one subsidiary. Right, so we want to look at what we call a parent. Right, so remember, a parent will exist in a group. Right, a parent is an entity, right, that acquires shares in another entity, that acquires shares in another entity, right, such that, right, it then exercises control over the other entity. Right, remember, when we talk about a company is made up of shares. Right, so if you buy enough shares, you will be able to now determine decision making in a particular company. So the one that controls the majority of the shares is most likely to have control of that company. All right, for example, if we have got a company, right, and in that company we then go and buy 80% of the shares of that company. right? It means that, because remember, a company is like a democracy. Decision making is done at board level, and the board is usually a reflection of the shareholding. So if you happen to be having 80%, because decision making is by way of voting in a board meeting, which is dependent on the number of shares, it means a company that holds an 80% shareholding will then hold sway in terms of decision making, right? It will overwhelm anyone else who has got shares in that company. So if I'm company A and I hold 80%, and then the other shares maybe are held by various individuals. Maybe there's company B, company E, and company D. Maybe this one has got 8, maybe this one has got 4, right? And this one will then have, how much? Will then have, like I'm looking for 20, right? Let's say we've got that, and then we've got that, and the other person has got 10% holding there. Right, even if we combine these guys together, they only make up 20% of shareholding. Right, remember, we may have a company, and a company has got here in this instance 4 investors. Okay, right, these are our different investors. All of them, they have got a stake in that company, but company A holds the majority of the shareholding. Right, it means company A is then able to control this particular company, right, because they can outvote the other shareholders combined. So therefore, the decisions of the company that we have invested in as company B, we can actually determine decision making there. We can determine the policy or what the company does. So when you have that ability to outvote everyone as a company, we then say you have got control over that particular entity, and therefore you are the parent in this arrangement. Right, are we clear, good people? Are we understanding that? So a parent is an entity that exercises control, right? And usually, right, so what is control? Right, control is the ability, right? So for control to exist, the following should be fully satisfied. Right, the following should, right, be fully satisfied. Right, number 1 or number A, right, you must have power over the investee, which in this case we call the subsidiary. Right, so remember, in this module, we have a parent and a subsidiary. The subsidiary here simply represents the investee, the company that we bought shares from, such that we have control. Right, that's number 1. And then number 2, or number B, exposure to variable returns. Right, exposure to variable returns. And then finally, we get ability, right, to use this power, or to use power, right, to influence, right, the amount of the variable returns. Right, so a parent is an entity that exercises control over another entity that we call a subsidiary. Right, so the undermining theme is that a parent has got control over another entity. But how is control achieved? Right, 3 things must be satisfied. Number 1, power over the investee. Right, when we talk about power over the investee, this is the ability, right, to influence, the ability to influence decision making, right, over the crucial areas of the business. The ability to influence the crucial areas of the business. Right. So if you are the ones that makes the critical or the crucial areas or the crucial decision making in an entity, for example, you are the one who determines property, plant, and equipment acquisitions. Right. You are the one who determines which products should be manufactured, which products should be sold by the entity. You are the one who appoints senior management. Then you have the power over the investee. Right, then we are saying if you are then exposed to variable returns, right? A variable return, remember, if you invest in something, you get a return. For example, if you issue a loan to somebody, they will pay you interest, that's a return. So if you buy shares in another company, right? If you buy shares in another company, what you get in return is what we call dividend income. Right, so we are saying the dividend income that you now receive from your investment here is not fixed, but variable, which means the amount is not set out to a fixed amount, but it depends on profitability. And the higher the profit, the higher the amount, the lower the profit, the less the amount. Then you have variable returns. So here it should be in the form of ordinary dividends. It should be in the form of ordinary dividends, which are not fixed by nature. It should be in the form of fixed dividends, which are not fixed by nature. Right, you are the one who then makes a decision over the amount of dividend to be received. So you determine, right, the dividend to be issued. Right, so the decision making over the amount of dividend that is to be issued is also dependent on the parent. Right, when all these three are satisfied, you then have control over the other entity, and therefore you are the parent. Right, this can be achieved, but control can be achieved right by acquiring right more than 50% of ordinary shareholding. By acquiring more than 50% of ordinary shareholding, right, such that you appoint majority of the board of directors. Right, remember the board of an entity is appointed, right, and usually it's the people that have got the right to appoint the board. People have got the right to appoint the board will be those that have got shares, the shareholders, and they appoint the board of directors or the second board of director members according to the proportion of their shareholding. The one that has got more shares appoints more. So if a board has got 5 members, the one with more shares can appoint maybe 3. And therefore maintain what control, because their sponsored board of director members will then make decisions on behalf of the company, and they will take instruction from the company. Right, so if you have more than 40% of the shares, you can outvote everyone in terms of the board meeting. Right, however, it doesn't necessarily mean that anyone without 50% cannot be the parent. Right, we are saying control can be exercised, right, can still be exercised. Control can still be exercised right, can still be exercised. How do you spell that? Hey, how do you spell that? Exercised? Right, control can still be wielded, right, without majority shareholding. Right, that is less than 50%. Right, if the investor controls the decision-making structure of the entity. Controls the decision-making structure of the entity. Right, for example, let's say a board of directors runs the company, right, makes critical decisions. Right, the board of directors makes critical decisions. And then there are 5 board members. Right, then we are saying the investor, right, an investor, right, holding 40% shareholding is permitted, right, to appoint 3 of those directors. Right, so in this instance, we are saying, even though the company does not have majority shareholding, only has 40% shareholding. Right, however, we should be aware how decisions are made. They are made by the 5-member board of directors in this company. And the agreement of investment mandated the company or the investor to appoint 3 out of 5 directors, which means even if this company does not hold majority shareholding, where critical decision is concerned, they can still outvote everyone. So therefore, even if this company has got less than 50% of the shareholding, right, we are saying the company is still the parent in this arrangement. Right, remember, a group is when an entity invests in the shares of another company. Right, in this module, our group will comprise of a parent and 1 subsidiary, where the parent is an entity that has made an investment in another, such that the investment has given that company control over that entity. Right, what is control? 3 things must be satisfied. There must be power, there must be exposure to variable returns, and the ability to use the power to influence the amount of variable returns. Right, then we are explaining control to say, normally control is achieved if an entity acquires more than 50% of the shares of the other company. Right, they will probably outvote everyone when it comes to voting. But power can also be achieved if an entity does not, or control can still be wielded without majority shareholding if the investor controls the decision-making structure of the entity. Most companies' decisions are made by the board of directors and then passed down to the management to implement. So therefore, anyone who controls the board in this instance will then become the parent. Right, if our investor controls the board somehow by having the ability to appoint most of the directors there, then that particular entity is the parent in this arrangement. Right, then we have obviously the subsidiary. Right, this is the junior partner. I'm talking about the company. This is the junior partner, right, in the group arrangement. This is the junior partner in the group arrangement. Right, this entity is controlled by the parent. This entity is controlled by the parent, which makes decisions on behalf of this entity. Right, so this is called a subsidiary. So we have a parent, we then have a subsidiary. Right, it is important to note that, right, when we have a subsidiary, right, we'll then have the parent, right, then we'll have what we call non-controlling interest. Right, if the parent is having 80% shareholding perhaps, then it will mean that the non-controlling interest have a shareholding of 20%. Right, so the non-controlling interest here references the other shareholders, right, the other shareholders, right, in the subsidiary, right, who do not have control. Right, they are part and parcel of the subsidiary, but they do not control anything. Right, the ability to control resides with the what? With the parent. So they are non-controlling interest. It can be one or more shareholders. Right, so that when we look at the company and we are looking at 100% shareholding, we should be able to determine that how much is the percentage that belongs to the parent and also how much is the percentage that belongs to the subsidiary. So whenever we look at a subsidiary and we look at the investors in that company, right, we group on one hand the non-controlling interest, and on the other hand, we then have the parent in the subsidiary. Right, so this is an explanation of what a group is. It's basically just a company with its subsidiary. Right, that is at this level. When you go to higher levels, then you get more complex groups, but this one is just a simple group where we're going to be having one parent and one subsidiary. Any questions from the floor? Right, are we on the same page, good people?
So can a shareholder from the subsidiary also be a shareholder for the parent?
Sorry, come again. A shareholder from the subsidiary, can they be a shareholder from the parent's end?
Yes.
Well, it's quite possible that that may occur. A company can be a subsidiary, we can have a subsidiary, and then there is a shareholder there. And then a shareholder in that particular subsidiary also holds shares in the parent. It is quite possible. That is very, very much possible. But it won't have any implications in terms of how we account. Remember, when you run a company, you then issue a lot of shares and a lot of people can invest. You can have one person investing and it's a private company, or one or two, three shareholders who are private, or you can open up and anyone who wants to invest can invest. So it's quite possible. But it's not really relevant who actually the investor is. Anyone can invest synonymously in a company. So it's quite possible, but it won't have any what implications.
All right. Thank you.
Yes. Then we then have accounting, right, for a parent and a subsidiary. Right, so when we account for a parent and a subsidiary, right, number one, we have what we call separate financial statements. Right, separate financial statements, right, comprising of, right? The normal financial statements, the P&L account, right? Statement of financial position, right? A statement of changes in equity, right? And also the cash flow statement, right? And the notes, disclosure notes, right? So basically, when you look at the financial statements of a company, this is what you are going to have. In this module, we are going to look at the P&L, statement of financial position, statement of changes in equity. Right, these two will be covered in later modules in that level. Right, so we are saying that each entity, right, each entity will prepare its separate financial statements. Right, these are your normal statements. There is no complication. There is just a normal income statement. At this point, we ignore the group. Right, when they prepare this, there is no reference to the group. So the group will be ignored at this particular point. Right, then we also have what we call consolidated financial statements. We also have what we call consolidated, right, financial statements. Right, so when you look at the consolidated financial statements, right, we are saying this is a combination. Right, this is a combination of the separate financial statements. Right, of the separate financial statements, right, of the parent and the subsidiary. Right, after adjustments. So the consolidation process can be presented as follows. Right, you take for the parent, you want the separate financial statements. Right, you add with that of the subsidiary. Separate financial statements. What you get are the consolidated financial statements. Right, so basically, it's an addition of the two. But before the addition, you need to make certain adjustments, which I will allude to. Right, so if I am an investor, right, and I own a company which is a parent with 100% shareholding belonging to me, right, at the same time, I also have a shareholding in another company where I own maybe say 80% of that company shares. Right, it is important for me to know how my parent company actually performed during the year. So I'll create the separate financial statement for that. But I have an investment in the subsidiary as well. It is important for me to know how well I did in that company with my 80% investment. So I will calculate the separate financial statements there, and I will know whatever profitability is there, whatever in terms of the statement of financial position is there, I own 80% of that. Right. However, at some point, I may want to combine my investment in both companies, the parent and the subsidiary, so that I can know in total how much my investments did for me during the year, and I can calculate my net worth in both companies. So therefore, I will require that consolidated financial statements be prepared. So the consolidated financial statements are prepared by the parent accountant there. So they are created in the financial statements of the accountant. Right, the subsidiary or the non-controlling interest, they are not interested in the group because they don't have a share in the group. They only have a share in the subsidiary, so they are interested in the separate financial statements. But we are saying the parent who has an investment in both the subsidiary and the parent will therefore be interested in the combined value of the two companies. So we then create what is called the consolidated financial statements so that that information can be readily available. Right, then we come to this that we call adjustment. Right, this consolidation, before we go far, I'll come to adjustment. Consolidation.
Sorry, David, you said that the consolidated financial statement is done by the parent accountant.
Yes, it's done in the books of the parent by the accountants from that side. It is not done at what? Subsidiary level, only at group level. Yes, only the parent consolidates. Right, let's be clear, consolidation, right, is a separate, right, set of accounts. Right, remember, I will already be having my separate financial statements. Then I create a third financial statements on the side to combine the information in the two. So it doesn't mean that the separate financial statements will change. I will still have those separate financial statements. Right, then from there, we are saying consolidation, right, is the addition line for line or line by line of the statement, P&L items, right, statement of financial position items, as well as the statement of changes in equity items. So you just add like for like. Income of the parent plus income of the subsidiary, depreciation of the parent plus depreciation of the subsidiary, rental expense of the parent plus that of the subsidiary. But remember, all of this is subject to adjustment. There are certain adjustments that you must make. Right, so very simple. We need to prepare the consolidated financial statements whenever we have a group. What is a group? Right, at this level, it's an arrangement where we have an investor investing in another company and having control in that company, so that we then recognize a group with a parent and a subsidiary. Right, these will prepare separate financial statements, but from the groups, from the parent side, we also need a set of consolidated financial statements where we combine the financial statements of the parent and the subsidiary so that we can combine, we can actually have a combined value of the owner's investments in both entities. So we call that the consolidated financial statements. Consolidation is the process of adding line by line of similar items or like items in the two financial statements, but it is subject to the following adjustments. Right, so before you combine, you must make these adjustments. Right, what starts is the adjustments, and then after the adjustments, we can then combine line by line. We'll just add. Number one, eliminate common items. Right, eliminate common items. Right, when we talk about common items, right, these are statement of financial position items. Right, these are statement of financial position items. Right, these are statement of financial position items. Right, remember in the statement of financial position, we are talking about assets. Right, we are talking about liabilities and equity. So assets, liabilities, and equity. Right, what is unique about this is that they appear in both financial statements. They appear in both financial statements. Right, but opposite of each other. Right, and hence they cancel each other out. Right, and then they cancel each other out. Right, before consolidation. Right, these are a result of intercompany transactions. Right, these are a result of intercompany transactions. Right, it simply means that these guys have had transactions with each other, and those transactions have resulted in balance sheet items. Right, e.g., parent borrows a loan of 100,000 to the subsidiary. So obviously that's an intercompany transaction. It's a transaction between the two members of the group. Right, if you go to the parent, in their statement of financial position, they will recognize a loan 2, which happens to be an asset with a value of 100,000 if nothing has been paid by the end of the year. Because the parent is the one that gave out the loan to them, that loan is simple an investment. And therefore, an investment is an asset with a debit value. It will appear in the statement of financial position as a loan 2. Right, but if we go to the subsidiary, right, in the statement of financial position, this will be a loan from. Right, this will be located as a loan from, and this is a liability with an amount of 100,000. Right, that's the same loan, but because it was given in the same group, it will appear as an asset to the parent and as a liability to the subsidiary. All right, so we are saying that When we now combine the two companies, in the form of consolidation, we are now combining the companies to create one bigger company, which is a group, and then we create the separate financial statements. So remember, we take the parent, we take the subsidiary, we combine them, it becomes one company. That's what we are doing. That's consolidation. Right. In essence, we are saying, therefore, when we look at the two companies as one, we are saying that a company cannot loan itself money. Right. Are we clear about that, good people? In the separate financial statements, fine, the parent can recognize an asset and therefore record this in the what? Statement of financial position. But then again, we are now saying in the combined financial statements, the two companies, we are looking at them as one. And therefore, we are saying a company cannot invest, cannot give itself a loan. So therefore, at group level, we are saying this loan is not recognizable. And at group level, we are saying the loan should be eliminated from the financial statements. So these two amounts will be deducted from the what? Combined financial statements. They won't appear there. Are we clear on that, good people? Are we understanding it?
Yes.
Right. So it's important that we understand that, because that's the basics of consolidation. That's the basics of consolidation. Right. So if I were to create a consolidated financial statement here, right, looking only at the information that we have. Right. If we check the separate financial statements, so I'll just say separate financial statements of the parent. We also take the separate financial statements of the subsidiary here. We are now combining this. Right, on the day of the transaction, right, parent gives a loan to the subsidiary. Right, what is going to happen is that these guys, in their assets, they are going to have an increase in terms of the loan too, with an amount of 100,000 here. Right, so in their books, in the separate financial statements, we are likely to see 100,000, right, in the form of a loan. Right, we can also say in their bank account, these guys, on the day that they issued the loan, right, there was a minus 100,000 in their books there. Right, because they issued a loan, they deducted the 100,000 from the bank to issue to the what? To the subsidiary. But what happened in the subsidiary's books, right? In their liabilities, the subsidiary will then have a loan from. This will be a loan from. Right, and the amount will be an amount of 100,000. Okay, and which will be a negative thing. Right, they are receiving the amount. They are receiving the amount. Sorry, they are receiving the amount. So to them, it's a positive figure. Right, that's a loan. Then in the bank here, these guys are going to be receiving the amount here. Right, then we have the consolidated financial statements. Right, so when we combine these and compile the combined financial statements, right, we are adding like for like. So we will be adding here. Right, so that we get our values there. Right, when we get to the bank is very simple and straightforward. We don't have to do anything at consolidation. No elimination is going to be needed. Why is that so? Right, the money is going to leave the parent's books, right, from the bank account of the entity, and is going to go into the bank account of the subsidiary. So therefore, in the parent's books, the transaction affects a bank account. In the subsidiary's books, it affects also an account with the same name. So that when I combine these, it will automatically adjust. Remember, I'm now combining this and I'm saying this is the group. And the group must record its bank account combined. Right, in this instance, we are saying we took from the left hand and gave to the right hand. But overall, the group's bank account did not change. And this will automatically reflect here. Because on one hand, there was a negative, which means a withdrawal from the bank. On the other hand, there was an increase in the bank. It doesn't change a thing. Overall, when we look at the company's bank account, combining the parent and the subsidiary, there was no movement because we only recognize a movement at group level when the transaction occurs with outsiders. This is an inside transaction. Right, when we go to the loan, it's a different story, right? Because here we have an asset item, which is loan to, right? But in the subsidiary, it affected a different account, which is loan from. So therefore, when we now add line for line, right, there will be no movement or there will be no cancellation of this transaction on its own, right? Because if I just add here, I will then have 100,000 here in the form of a loan to, and then I'll have also a loan from, right? We know that when we want to calculate the overall value of the entity, which is equity, right? Equity is assets minus liabilities to determine the value of the company. This will ultimately what? Cancel out, because to calculate value is assets minus liabilities. Moreover, we are saying the separate financial statements can recognize this transaction separately. But at group level, we don't recognize this transaction because it occurred within the group. It doesn't affect anything inside the group. It affects outside the group. So therefore, we are saying that since we are considering now the two companies combined as one, a company cannot loan itself. So this loan is null and void at group level. But because these the accounts which are affected in the subsidiary and the parent are not the same, we will then have a problem of this loan cropping up or showing up in the statement of financial position. So the solution, therefore, is that before consolidation, where there are common items, which means the same amount appears twice in the parent and the subsidiary books, but at opposite ends, such that it cancels itself out. Before consolidating, we must just come and do this. Right, so that when we are looking at this transaction, there is nothing that is remaining in the statement of financial position concerning an intercompany loan. This is simple because at group level, when we combine the two companies, we recognize transactions with outsiders outside the group. Right, so we are saying a company within itself cannot transact, and we look at the consolidated financial statements as that of one company. Are we clear on that, good people? Are we understanding it? Any question?
No.
No question, or you don't understand?
I'm understanding.
All right, thank you. Right, so that's the consolidation process. The first thing is to identify where transactions have occurred and have led to balances in the statement of financial position, which are common. You eliminate them. Right, at group level, we only recognize transactions with outsiders from the group. A company cannot take money from its left hand, give to its right hand, and record that in the books. It's null and void from a group level. Right, so we have dealt with one type of adjustment, which is the elimination of common items. Number 2, elimination of intercompany transactions. Right, elimination of intercompany transactions. Right, intercompany transaction gave us common items. We have eliminated common items, but the transactions must be reversed also. Right, so when we talk about an intercompany transaction, now we're dealing with the P&L. Right, so we're dealing with P&L items. In the P&L, we deal with income and expenses. So it's income and the expenses. That's what we deal with. Then we are saying, right, when we deal with income and expenses, when we eliminate them, these result from, right, intercompany transactions. Right, these are also resulting from intercompany transactions, and result in one entity recording an expense. And another income of the same amount. Right, these cancel out before consolidation. Right, so it's almost the same thing. When we say common items, these are balance sheet items resulting from intercompany transactions. When one gives a loan, the other will then record as a loan to, the other a loan from. But when an intercompany transaction results in one entity having an expense and another having income or vice versa, then it's an intercompany transaction. Right, then in that instance, we need to eliminate this. I'll give an example. Right, a subsidiary rents a property from parent, 10,000 a year. Right, to the sub, right, the rent represents an expense, right, of 10,000. To the parent, right, this is rent income of 10,000. This goes to expenses. This goes to income. But remember, at group level, when we combine the two companies, we are saying the group did not earn any rental at all. So therefore, this rent must be eliminated at group level. So when you now create your consolidated financial statements, right, these two will simply cancel each other out. And then you won't have this transaction appearing in the books. If it so happened that the one who is supposed to pay the rent did not pay it, then the other entity now will record it as an accrued rent, the other one as what? Accrued income. So it will now appear in the statement of financial position. It will cancel out as an intercompany common items. But if these guys, if the subsidiary pays its rent on time, then it's just an intercompany transaction only, and then you just need to eliminate it. We are saying at group level, we never rented any property to anyone, and we did not earn any rental income. So that's an example of an intercompany transaction. Then we eliminate unrealized profit. we eliminate unrealized profit. Right, it is quite possible that when these entities enter into transactions, they don't enter into transactions without economic substance. Right, in other words, when the parent is selling to the subsidiary, they may charge them a markup and vice versa, so that one entity then earns profit within the group. So unrealized profit, right, is profit earned within the group, right, and recorded, right, in the P&L as well. So when the parent maybe buys inventory at 20 Rand and sells it to the subsidiary at their normal selling price of 30 Rand, they, the subsidiary, have made a profit within the group. So we are saying that profit, when we go to the group level, it cannot be realized. It has to be eliminated. So this comes from sale of property, plant and equipment within the group.
Can you please repeat the last statement? I didn't get it well.
Okay, right, and inventory as well. Right, we are saying, let's say the parent sells inventory to the subsidiary. It buys the inventory for 20 Rand and sells it to the subsidiary at 30 Rand, which is their normal selling price when they sell to outsiders. They, the parent, then make a profit. Are we clear?
Yes.
Right, but that profit we are saying was earned within the group, not with an outsider. So when we now combine the two companies to make one, we are saying there was no sale by the group, because a sale is only recognized when the group is trading with an outsider. So any profit that may have been realized in the separate financial statements emanating from a transaction within the group, that profit must be eliminated from the books before consolidation. Right, I hope you understand it.
Yes.
Right, so after these three adjustments, you just combine, you add line for line, and then you get the consolidated financial statements. So in its simplest form, this is what we call consolidation of financial statements. Any questions from the floor? Right,
No.
are we here? So what we are going to do, I want you to go through to learning unit number 1. Right, I've already given you the theory. Then you look at the examples that they have given of consolidation. Right, so we are going to look next week at calculations at what we call consolidation, right, on the acquisition date. So we are going to practice this. Right, this is just practice. You will never find an easy question like this in the exam. Right, most of the exam questions will then be assuming that the company was acquired a number of years back, and then you are consolidating in the current year. But to start with, we are going to look at a situation where a company buys shares in a company and then wants to determine the combined value immediately. So that is consolidation on the acquisition date. So this is learning unit number 1. Right, so this is learning unit number 1. So what you do is go and have a look at that and practice if you can on the questions that are there. And then we are going to discuss this part next week. So for today, I wanted to cover the theory, just introduce the module, and just highlight what consolidation is. Right, you will see when we now study, right, we'll then have an in-depth or in detail overview of these things. This is just introduction, but there are extensive calculations that will follow. And you will see these will come somewhere in the middle of the syllabus thereabout. For now, we just want to do a simplified version of consolidation first. And then after that, we'll progress until we get to the difficult stuff. Right, it is a very tricky module for students only because it's new. Students have been taught the profit and loss, changes in equity and balance sheet of a single standalone company, and now we're introducing consolidation. But by and large, it's a very easy module once you get the hang of it. So we should be pushing and aiming to get high marks on this one. Remember, there is no exam. It's all assignments up to the end, but that's just a way of describing how they assess. The final assessment, which normally carries 40, 50 marks there, would be same with what an exam will look like. So you do write something that looks like an exam at the end. So let's prepare for next week and just make sure we are moving together. For this week, let's hold it here. Thank you very much.
Thank you.
Good people.
Thank you.
Right, don't forget to share your emails with me. Share them on the group, not on the main group. Right, are we there?
Yes.
Yeah, share with me your emails, but on the group for this module, so that I
All
can
right.
be recording with you. But I don't want to promise that I'll be able to show it today. I might be able to share it on Monday. Eh?
All right.
Yeah, thank you.
Thank you.